Can I briefly explain auto deleveraging on Bybit as I'm down to 1 times 2 on my 1x short at the moment to keep out of the red. Okay. Here we go. So for a position to be opened up, there has to be a willing buyer on the other side of the market, right? So in the event that there are a lot of liquidations, which means there are positions that have to be forcibly closed. If there is not an insurance fund, for example, which is what BitMEX employs, if there is not an insurance fund to cover the potential difference between the price at which you're going to go bankrupt, right? So let's start off with explaining the difference between, let's start off with the difference between liquidation price and bankruptcy price, okay? And this is going to deal with the concept of maintenance margin, right? So when you open up a leveraged trade, you have to put up margin, right? That's your collateral to take the money that is loaned to you either from the broker, and that money typically comes from an investment bank, or in Bitfinex's case, it actually comes from community funding, for example. All exchanges do this a little bit differently, but I digress. So, and you know, for BitMEX, BitMEX is a good example, and Bybit as well. It comes from individuals that loan money to be loaned out in the form, and they receive, you're paying them basically a fee to do that. So, and that's the Bitfinex model of community funding for leverage. So, there's also a portion of your margin that is known as maintenance margin. And essentially what that is your liquidation price is going to be when you've lost all of your margin minus your maintenance margin. Your maintenance margin is still left. And your maintenance margin is there to cover any fees that might be associated with closing out your trade. And they're also there to cover any divergence between the mark price at which you have reached the liquidation price and the price where you actually get filled at, to cover slippage, essentially, right? Because when you get liquidated, let's say you're long, and so when you are liquidated, let's say you have 10,000 contracts long and you reach your liquidation price. Well, that's 10,000 contracts that needs to go somewhere. There has to be a willing buyer and seller, right? There is no divergence. There's one long for every short. So there has to be a willing buyer on the other side of the market. Somebody has to be willing to sell the contracts, right? For everything to close out and go equal, right? Now, if there is not a willing buyer, depending on liquidity, depending on the market, depending on the price, there's going to be a divergence in the price that you get filled at, and the divergence where you actually go, where you actually get liquidated. And that maintenance margin is, in theory, there to cover any slippage or fees that might be associated with that cost, so that everything can balance out. Now, your bankruptcy price is the price at which you have lost everything, your margin plus your maintenance margin, okay? The totality of your margin, right? And at that point, any slippage from that level now has to be covered by somebody else. And I'll tell you what, the exchange sure as hell is not going to cover it. So what do when such a situation occurs? They employ auto deleveraging, meaning they forcibly, if there is not a willing buyer at your liquidation price, and if there's not a willing buyer once your maintenance margin has been utilized, they're going to employ auto deleveraging, and they use a hierarchy, like basically who's the most profitable, who's been in a short the longest, and they're going to force your orders closed to close out the trade that's now being liquidated. That's how it works. Otherwise, if they did not do that, they would have to socialize losses, basically meaning anytime that occurred, they would take an equal amount of contracts off of everybody else. They don't do that. And I think that's the better way to do it. Basically, you know, if you are super, super profitable, if you just had a really super dope killer trade, they're going to say, hey, it's your turn, buddy. Time to throw a poker chip into the hat because you're buying coffee tonight. And they'll close out as many of your contracts as necessary to actually settle the books.